Welcome back to the channel. If you copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about PDD Holdings, ticker PDD. This is on ADR because it's a Chinese listed organization. And essentially, what they do, they are the Chinese version of Amazon. Of course, if we open the chart, you can see that during the time of the pandemic, this company was doing very well. Then, of course, after the tech winter, they lost a very good share of market cap. Eventually, the company came back to an extent, but now seems to be losing again some ground. And some of this upward trajectory we see here over the good part of 2024 and 2023 is because at that time they were launching Temu, a very successful business that has significantly increased their market share revenues. However, as we see here in this latest trend, that may not be enough to contain some of the headwinds that they are experiencing. Essentially, this company is China's third largest e-commerce platform, and they make money by charging merchants for advertising. So that's about 53% of their revenue. And they also take transaction fees, which is about 47% of their revenue. Essentially, they act as a shopping center that charges rent and takes a cut of sales. And the problem is, if we look at the financials, that revenue growth has been stagnating for quite a while. So we can see here, right, 2017, 2018, we can see how progressively revenue growth has been slowing down significantly to the point now that for a company of this kind of industry is only achieving 20%, which is not impressive by any means. Of course, the gross profit margin has slowed down as well. That's typical as business mature. But EBITDA margin and net income margin have been slowing down as well in recent quarters too. So when you look at that, for the last 12 months, EPS has actually contracted. And for this year, it's expected to do so. And for 2026, it's expected to increase 20%. However, I think those expectations might be a bit too optimistic. So I mentioned before how the revenue growth stagnated. Their operating profits turned negative, falling 21% year on over year. Basically, what's happening is that they're getting crushed by competitors who can sell directly to consumers while they are acting still as a middleman. If you're familiar with the latest changes in e-commerce, companies like Shein now sell directly into the consumer. So the question is, how is management dealing with this? Well, they are throwing money at the problem. They admitted that they are in a big problem that is really unsustainable and have launched 100 billion subsidy program. So that's about $14 billion. And they're burning that amount of money to keep merchants on the platform. So for context, their Q2 2025 revenue was about 100 billion yuan. So they're subsidizing nearly an entire quarter's worth of revenue through this program. And it seems that it's failing at the moment. Management admitted that profits are not sustainable and will keep declining. And they've warned investors several times about this. So they're essentially paying merchants to stay while losing market share anyway. So this could be a bit of a death by a thousand cuts situation if we look farther in time over, say, 2026 and beyond. And there are a few things that I see that could drastically change the stock price as they come as publicly available information. So first of all, between now and the end of the year, we could see Singles Day disaster. So that'll be on the 11th of November, a couple of months from now. That's essentially the equivalent of China's Black Friday and represents about 20% of annual e-commerce gross merchandise value. So it's pretty significant. It will be a test of whether these subsidies are working, and it will also enable us to compare the performance to some of the competitors. There is also in late October the Q3 cash burn reveal. So we will see by then if they are burning through their cash pile faster than expected. But we could also be perceiving negative free cash flow and accelerating losses. Management should also provide some guidance as to whether or not they will continue the subsidies. And I think the most important out of all those will be taking place in December. December is when the annual contracts with merchants are renewed. It's pretty much the nature of the business cycle. Year-end relationships are either continued or discontinued. So we could see that despite these subsidies, merchants may still decide to leave. And that should not be a surprise considering that there's a lot of strain in the Chinese consumer looking to get many deals, looking to get many different ways to get their merchandise out. So with all those things, I see plenty of opportunities while the stock could go down to 100 or perhaps even lower down here around the $80 mark, say by early 2026. So we'll have to keep an eye on that. It's something that I think at the moment presents a pretty good entry point. However, there are key risks to the thesis as well. At the moment, the company still has a strong balance sheet. So technically, they could afford to remain on the negative for quite some time before the fundamentals really start deteriorating, right? And when we look at how the market's perceiving this stock, if I just hide this for a second, we can see that in terms of the valuation, of course, it's not as high as the post pandemic start, but at the same time, it's not as low as in all the time. So, as a matter of fact, it's been increasing all the way since April. So that suggests that markets are not punishing this stock for the time being. And part of that, again, could be the success that they're having with Temu. The main risk to this thesis is if they actually manage to perform a strategic sacrifice. In other words, they are sacrificing part of their operation in hope that some of the other initiatives like Temu will actually carry forward the whole company. And it could happen. So that is something that we should be keeping an eye on. But in summary, they face strong competition from other market participants and also a very mature e-commerce market. With the combination of decelerating growth, collapsing margins, management warnings, and institutional exodus, that is to me a short setup, but the timing might be a little bit uncertain. For now, I'll put this trade on my watch list. If it goes, say, above 130, I might consider going short, but I expect again this to be a play that could be really taking full shape in early 2026. Hope you enjoyed the video. See you soon.